Howdy, y'all. Welcome back. It's the weekly economic update for September 20th, 2021. Hope everyone had a good weekend. Astros won 2 of 3, which is always good in my book. And now they're headed off to Anaheim to play the Angels. So late night games. So if you like Astros after dark, after midnight, this West Coast trip is right up your alley. So, all right. Interesting weekend. It looks like the markets took a little bit of a turn for the worst with some of the news that was coming out late last week and into this morning. The contagion from, or the potential contagion from the Asian markets, especially with what's going on with Evergrande. I talked about that on Friday's video, went through an article discussing the problems with Evergrande, which is the largest real estate firm in the Chinese market. So we'll see what happens. The market looked pretty crappy today, but we'll see what tomorrow brings. So let's go ahead and jump into, here's my agenda. I actually wrote stuff down this time. So we're going to go through the weekly economic update. I have a couple of white papers. I have 2 articles. And I'm going to start doing a weekly tip based upon the 6 areas of financial planning. So, it may not be exciting stuff, but for the novice out there who's maybe just it's the first time they've ever seen me, and maybe the first time they've sat down and started doing some financial planning, this will help get you started in the right direction. So, all right, let me share my screen. There we go. All right, the week on Wall Street, stocks weakened ahead of this week's Federal Reserve meeting and amid persistent concerns about the Delta variant's impact on the economy. The Dow Jones was flat at negative 0.07. The S&P 500 fell 0.57. The NASDAQ lost 0.47. And the MSCI dropped 0.65. Next paragraph, stocks struggle despite a string of economic reports painting a healthy picture of the U.S. economy. Investor sentiment remained cautious. Pretty good idea. While tamer inflation and higher than expected retail sales may typically be constructive for the market, any investor enthusiasm it generated was fleeting. The market appeared all week to be encumbered by a tentative, apprehensive mood. The Delta variant remained an overhang, but it was more than that. Investors appeared more concerned about September, which historically has been a weak month for stock prices. The market was also concerned about fiscal and tax policy proposals emanating from Washington, D.C., news of an economic slowdown in China, and by what the Fed may announce following its September 21st, 22nd FOMC meeting. So, I've been talking about this for a few months now that once the steam from all this fiscal stimulus runs out, we'll see what the market really does. All right. Next section, taking the economic pulse. A series of economic reports released last week provided investors with a broad snapshot of the state of the economic recovery. Inflation showed signs of moderating, rising 0.3, an elevated rate, but well below June and July's increases of 0.9 and 0.5 respectively. The consumer remained strong as retail sales rose 0.7, an unexpected jump. Manufacturing reached pre-pandemic, while the labor market continued its recovery, with initial jobless claims coming in near pandemic lows and continuing claims hitting near new pandemic low. All right. Economic data this week. Tomorrow we have housing starts. Wednesday, existing home sales and the FOMC announcement. Thursday, jobless claims, index of leading economic indicators, PMI, or the PMI composite flash. And Friday is new home sales. Few companies reporting earnings this week. Tomorrow will be Adobe, FedEx, and AutoZone. Wednesday, General Mills. Thursday, Costco, Darden, and Trip.com. And I think that's it for the weekly update. I did have some white papers that are coming out this week, so I'm going to go ahead and blast through these real fast. First one is called The Underutilized Benefits of a Health Savings Account. Healthcare can be one of the priciest yet essential parts of life's journey, and yet many struggle to utilize financial tools that may help. Take the Health Savings Account, or HSA, for example. In 2019, 55% of those with HSAs did not record a distribution, also did not receive either employee or employer contributions. This suggests that the lack of distributions are due to account holders becoming disengaged from their accounts rather than not having access to this cost-saving financial tool. And yet, for those looking to help manage the financial impact of healthcare, a health savings account may just be the ticket. HSA Benefits, a large draw for many that are tax benefits. A large draw for many are the tax benefits inherent to HSAs. I can talk today. Contributions through an employer are always pre-tax. You can invest the funds after your account reaches after the account balance reaches a certain level. Distributions for qualified health expenses aren't taxable. Additionally, unlike a flexible spending account, which FSA, which is funded with pre-tax dollars but must be used by a specific deadline, HSA contributions can remain in your account to be used for future medical bills at any time. In short, this means there is no use it or lose it penalty. Keep in mind that if you spend your HSA funds for non-qualified expenses before age 65, you may be required to pay ordinary income tax as well as a 20% penalty. After age 65, you may be required to pay ordinary income tax on HSA funds used for non-qualified expenses. HSA contributions are exempt from federal income tax. However, they are not exempt from state taxes in certain states. So I guess the way I would, relate this in, layman's terms, it's kind of like a Roth IRA that, as long as you use it for medical expenses, you don't pay taxes on any of the withdrawals. So that's a great thing. Now, if you do use it for, every day, just decide, say you have 50 grand in there when you're 65 years old and you say, hey, I'm not going to use this. I have, plenty of money set aside somewhere else. You would just pay ordinary income tax like a traditional IRA. So it's kind of the best of both worlds. All right. HSA contribution limits for 2022. HSA contribution limits are adjusted annually for inflation. For 2022, the self-only contribution limit is $3,650 or $7,300 for families. This is a $50 increase for individuals and a $100 increase for families from 2021. Wow. Thanks, government. The contribution limit refers to contributions from both employers and employees or family members. These adjustments are rounded to the nearest $50 to account for inflation rates, which are determined using the Consumer Price Index for all urban consumers. How to use your HSA. The IRS or HSA provider are great sources for when getting started. For example, the IRS recently issued a reminder that at-home COVID tests, face masks, and sanitizing wipes can all be purchased or qualify for reimbursement through an HSA. In addition, the IRS offers an interactive assessment tool that can take the guesswork out of what qualifies as an HSA-friendly expense. How nice, government. So awesome of you. All right. Next one is your annual to-do list. With financial, business, and life priorities, do you need to address for the coming year? Now is an excellent time to think about investing, saving, or budgeting methods that you could employ towards specific objectives, from building your retirement fund to managing your taxes. You have plenty of choices. Here are a few ideas to consider. Can you contribute more to your retirement plans this year? In 2022, the contribution limit for a Roth or a traditional IRA is expected to remain at $6,000, $7,000 for those who are making catch-up contributions. Your modified adjusted gross income may affect how much you can put into a Roth. With a traditional IRA, you can contribute if you or your spouse have taxable compensation, but income limits are one factor in determining whether those contributions are tax deductible. Keep in mind, this article is for informational pages or blah, blah, blah. Once you reach 72, you must begin taking required minimum distributions from a traditional individual retirement account. In most circumstances, withdrawals from traditional IRAs are taxed at ordinary income, and if taken before 59.5, may be subject to a 10% federal income tax penalty. To qualify for tax-free and penalty-free withdrawals of earnings, Roth 401k distributions must meet a 5-year holding requirement and occur after age 59.5. Tax-free and penalty-free withdrawals may also be taken under certain other circumstances, such as the death of the owner. Employer match is pre-tax and not distributed tax-free during retirement. Next thing you can do, make a charitable gift. You can claim the deduction on your tax return, provided you follow the IRS guidelines and itemize your deductions on your Schedule A. Paper trail can be important here. If you give cash, you should consider documenting it. Some contributions can be demonstrated by a bank record, payroll deduction, credit card statement, or written communications from the charity with the date and the amount. Incidentally, the IRS does not equate a pledge with a donation. If you pledge $2,000 to a charity this year, but only end up giving $500, you can only deduct $500. Wow, that's amazing. All right. See if you can take a home office deduction for your small business. If you're a small business owner, you may want to investigate this. You may be able to write off expenses linked to the portion of your home you use to conduct business. Using your home office as a business expense involves a complex set of tax rules and regulations. Before moving forward, consider working with a professional who is familiar with the tax rules as they relate to home-based businesses. I can speak to this. I've been working from my house. I think I moved most of my operations out of my office in 2015, I think, and probably a year or two before we moved. And so, yeah, you do. And my wife has worked from home for, going back to like 2006. So, we've been doing this process for the better part of 15 years. And it's actually not too hard. I for my personal taxes, I use TurboTax. It has a lot of walkthroughs and kind of cheat sheets to help you with it. And so, like in my case, this is like a 13 by 13 room, and the room my wife uses is about the same space. So you're able to deduct like the energy, gas, anything you use, internet. That portion of the house, you're able to take a deduction on it. Also on your property taxes and your insurance expenses. So you're able to deduct quite a few costs. Especially if you're making a decent amount of money, it does help out. So something definitely to consider. If you are self-employed, it may make sense to, if you don't already have if you're already using a portion of your house for an office, you might as well start deducting it. Open an HSA. Hey, we just talked about that. HSA works a bit like your workplace retirement account. There are some HSA rules and limitations to consider. You're limited to $3,650 in contributions if you're single, and $7,300. We just talked about that. All right. So what's next? Pay attention to asset location. Tax efficient asset location is one of the most important, is one factor that is to be considered when creating an investment strategy. Next tip, review your withholding status. Should it be adjusted due to any of the following factors? You tend to pay the federal or state government at the end of the year. I actually prefer that. You tend to get a federal tax refund each year. So yeah. Personally, I'd like to write a check for like 50 cents. If you could time it that perfectly with deductions out of your payroll throughout the year so that you have to write them a check for like a nickel, that would be perfect. But it usually doesn't work out that way. You were recently married or divorced. You have a new job and your earnings have been adjusted. Consider consulting with your tax, human resources, or accounting professional before modifying your withholding status. That's my disclaimer voice. Did you get married in 2021? If you did, congrats. Are you coming home from active duty? There's some tax credits there, and consider the tax impact on any upcoming transactions. Also, if you are retired and in your 70s, be sure to remember your RMDs. So we've talked about that. All right. Had two articles I did want to touch on. The first is from my favorite investment geniuses at First Trust. This comes from Brian Westbury, chief economist there. This is called Resist Inflation Complacency. All right. Some analysts and investors breathed a big sigh of relief on inflation when it was reported last week that the CPI rose 0.3 in August versus a consensus expected of 0.4. But we think any sense of relief is premature. First, in no way, shape, or form is a 0.3 increase in consumer prices indicative of low inflation. Consumer prices rose at 3.3 annual rate in August, which is still well above the Federal Reserve's 2% target. Yes, we are well aware of the Fed inflation target is for the change in the PCE deflator, which always runs a little lower than the increase in CPI, but it doesn't run anywhere near close to 1.3 points lower, which is what I'd have. God, I can't read today. Which is what I'd have to do for the Fed to hit the long run 2% inflation target. Woo. Second, a number of sectors had price declines in August that should not persist. For example, airlines fell 9.1% in August and now are 17.4% below average fares in 2019, which was pre-COVID. So as COVID generally recedes, these prices should rise. Third, housing rents are likely to accelerate sharply in the years ahead, including for both actual tenants as well as owners' equivalent rent, which is the rental value of homes occupied by homeowners. With the eviction moratorium in place, rents have grown unusually slow. Rents have grown unusually slow for the past 18 months, but going back to the 1980s, rents tend to lag the Case-Shiller Home Price Index by about 2 years. Now, with the national eviction moratorium finished, look for rents to make up for lost time. And because rents make up more than 30% of the overall CPI, any predictive lower inflation numbers in the future are saying other prices will fall. Ultimately, however, it's important to recognize that inflation is still a monetary phenomenon, and the M2 measure of the money supply is up about 33% since February 2020, pre-COVID. Eventually, that will translate into substantial rise in overall spending and nominal GDP, real GDP growth plus inflation. And since the Fed has little to no control over real GDP growth beyond the short term, this means higher inflation. Next paragraph. One way to think about this is between the late 1950s and the early 1980s, the ratio of nominal GDP to M2 hovered in a narrow range of close to 1.8, which means what that means is that every new dollar of M2 translated into 1.8 more dollars of spending. And if this ratio remained the same, then a 10% increase in M2 leads to a 10% increase in overall spending. The ratio rose in the 1990s. Interestingly, so did real GDP growth. So, all right, let me just talks about how the Fed is going to be meeting this week. We don't anticipate any significant changes to monetary policy at this meeting, although we do expect a hint that the Fed will announce a tapering of quantitative easing to begin after the next meeting in early November. So, good stuff. So I'll attach this to the show notes, and you are welcome to go out and read it. All right. Next article. This comes from LouRockwell.com. The title is From the Notebook, Evergrande, and How About That Dollar Bear Market. This is written by Thomas Luongo. It starts out, while it's becoming easier to see how various projects supporting the Great Reset are progressing just by reading the headlines and seeing how things are spun to manufacture consent. Sometimes a story is deeper than the headlines. I've watched the situation surrounding Evergrande's collapse in China unfold like everyone else in this space. Like many of you, a hat tip to Zero Hedge for being on this from the beginning. I could tease out some of the story just by following the progression of headlines, especially in light of China's big changes in attitudes towards foreign capital. Over the past 2 years, China's cracked down on a number of sectors within its economy. It started with the moves on Hong Kong and the extradition law, which sparked huge protests in the summer of 2019. It evolved into curious disappearance from public life for months of Alibaba CEO Jack Ma. This summer, we saw China uproot the cryptocurrency market by kicking out all Bitcoin miners over a weekend. They've doubled down on this policy again recently. In September 2019, I wrote about the China's move on Hong Kong were preemptive moves to undermine British influence there through the banking system, because the protests in Hong Kong last year looked an awful like Portland's and Minsk and Kiev's in 2014, et cetera, et cetera. There's a color revolution angle here that hasn't been openly discussed. All right, so let me skip down here a little bit. All right, since then, Evergrande. Let me skip back up here. All right. So. All right. Well, let me just start here. Since Evergrande's bonds have stopped trading altogether, angry property owners are surrounding the main building and company, as well as on its way to being China's Lehman moment. Saw a headline earlier on the TV about that. Evergrande's problems were so large that even disposing of assets over the past year did nothing to firm up its rapidly deteriorating balance sheet. Being the biggest mortgage lender in China, its collapse would be catastrophic for China's near-term financial health. And as of Friday, the PBOC finally began taking the situation into grander sense seriously. So, all right, let me see here. So it's a pretty long article. I'm not going to read through everything here. We covered a lot of the Evergrande's problems last week. So if you want to read through that on your own, since I've already gone almost 20 minutes, I will leave that for you to read. So, all right. So tips for this week are going to center around cash management. And, the first thing, why is that important? Why do you need to have good cash management skills? Because if you don't know where your money's going, it's really hard to save. It's really hard to plan for, whether or not you want to save for vacations or fixing your house or saving, putting your kids through school one day or whatever it might be. If you have no idea where your money goes, then it's really hard to start planning for the future. So the first thing I always recommend to folks is, go through and figure out a budget. If you make $5,000 a month gross, or that's what, you're paid out through your, what your net checks are into your bank account. What are you doing with that $5,000? How much goes to rent? And that's probably, or rent or mortgage. That's probably pretty easy to fit. Probably do that off the top of your head. You probably do your house, your car, a couple of basic expenses like, electricity and water. Those things are probably fairly stable, or what they are at this time based upon this time of the year. So, but where's the rest of your money go? How much money is spent going to Starbucks? How much do you spend going out to eat? Putting gas in your car, so by, creating a budget and using some tools that, 25 years ago, this was very tough. You had to, use a spreadsheet or, track all this stuff yourself, or in your checkbook, you used to write down all the little transactions, whether or not you took cash out or wrote a check or a debit card. Today, it's much easier. You can just import all this stuff, categorize everything. And, typically, like say you go to the Kroger and, buy groceries and use your debit card. Well, the first time you do that, you categorize it as groceries. And so from then on, every time a Kroger expense comes through, it should categorize it as a grocery expense. Now, let's say you go to Kroger and you buy, propane or gas, you could always, split it up or however the case is. So some of the best ones, that you can use, and this article does cover, goes through 8 different ones that you can use. I personally have used Mint. Back in the old days, Microsoft Money used to have a program that you could, download that came with like Office and all those things. So, but here in this list, it comes from, you have Quicken, Mint, YNAB, Envelopes, TurboTax, Future Advisor, Personal Capital. They also do financial planning and stuff. So, and Tiller Money. So, what I would suggest, I like Mint personally. It's fairly easy to use. But if you're not already using a budget or a tracking tool for your finances, I would strongly recommend doing that. It will help you get a better track of, where your money's going. And once you're able to diagnose where your money goes, you can say, hey, do I really need to go to Starbucks every day and spend $10? No, I can brew my own coffee at home. You could even buy your favorite coffee, brew it at home, take it with you in a thermos. Hey, problem solved. And you just save $5 a day or $10, however much you're typically spending. So, and you can spend a little more on the stuff you have at home. Buy the gourmet coffee, brew it yourself, take it with you. So, all right. Well, that's everything that I had for today. So, if anybody needs anything from me, feel free to write, email, or that is the same thing. Duh. Email or give me a call. I'm here all week. Don't have a super busy calendar this week. So if you need anything, I will be out on Wednesday getting my 6-week infusion. So if you called in the middle of the day, I may not be available because I'll be hooked up to an IV bag. But outside of that, I'm pretty much free the rest of the week. If anyone has any pressing matters, give me a buzz. Like I said, I'll be paying close attention to the markets right now since they do appear to be getting a little more volatile. So if anyone has any questions, feel free to give me a buzz. So have a good day, and I'll talk to y'all later. Bye-bye.